I think everybody hopefully can hear me. And we're going to go ahead and get started and start with our discussion on equity crowdfunding, which is a really interesting topic, especially here in the last week. There's been some changes in some of the regulations, but really in the last couple of years is an area that for startups and people who want to invest in startups, we've started to see some really interesting changes that I think are on the way to democratizing in a better way how startups can raise money and how people can get involved in actually investing in startups. So Carmen, I think you can hear me. I'm not sure, but if you can go to the next slide. And I'm sorry to the folks out there, for whatever reason, it will not let me share my slides. So before we get started, I've got a quick agenda after this. I just wanted to introduce myself. My name is Mickey Millsap. I am a partner in Redhawk Advisory. Redhawk Advisory is a venture capital investment firm that I started a little over 2 years ago with my partner, Matt Hoddle, here in Birmingham, Alabama. We are the investment manager for the almost 2-year-old Alabama Futures Fund, which is a $25 million kind of pre-seed to seed stage venture capital fund. So we invest in startups that are, still maybe a couple of founders, that are technology driven, have the opportunity to scale quickly, based here in the state of Alabama or willing to relocate here. We write checks sizes of $250,000 up to about $750,000 with the ability to write more follow-on capital into the companies that are performing well. So the idea behind the fund was to invest in Alabama companies and companies that want to base themselves here to help grow the startup technology ecosystem. In addition to doing that, I've got kind of a history in startups. Did my MBA at University of Texas. When I was in school, I co-founded a company called uship.com. While we were there, we raised about $50 million of venture capital, grew that, and then about 8 years into it, it stopped being a startup, and that's what brought me to Alabama. So I left and did a program called Teach for America. It brought me to rural Alabama, and then I fell in love with the state and loved the idea of ecosystem building. So we are really trying to develop Birmingham's version of a startup ecosystem. And that's something that outside of the fund, I try to stay pretty involved in. Just some things on the side. I am the executive director of a small nonprofit called K-12 Lean Labs that does work around K-12 innovation and education, of course. And I happen to be on the Birmingham Board of Education. So as you might imagine, it's been a very interesting few months doing that as we try to navigate this new normal. But my real work is in the funding world, where I work with startups, really even outside of the fund, of all different sizes. So I have friends that have started everything from restaurants to small consulting practices, all the way up to larger scalable technology companies. So this is what I love to do. Next slide, please, Carmen. Uh-oh, we may have lost her. That's okay. The next slide is just an agenda. And just to give you an idea of what I want to try to talk about today, and I like to keep things pretty casual. So I am going to set the session chat open, and I hope to get questions along the way, and especially at the end, leave some time for this. This can be dense stuff, and I think there are people at different spectrums of their sophistication with it. A lot of this is new. A lot of this I'm still learning. So I've tried to keep it where we can all digest it, and then if there are some questions later that are a little bit more sophisticated, we can handle them. People that are newer to this, I'm happy to kind of take those. So I've tried to take it in the middle. I want to start by kind of talking about the traditional startup fundraising and how that interacts with securities law. Don't worry, I'll try to keep it from being boring. Talk about the history and evolution of crowdfunding. Talk about the different types of equity crowdfunding, because there are different ways you can do it. And then really discussing if equity crowdfunding is right for you as a company, as a startup founder, or you as an investor. And one of the neat things about this, and we'll talk about different types of investors, is the market's really opened itself up to allow more people to get involved in investing in earlier stage startups. And then hopefully we can have a couple questions and some discussion on alternative asset investing, which is really anything that's, I consider that anything non-stock market, so private companies, early stage companies. Next slide. So I want to start, and maybe this may be really hard for you guys to see, and I apologize. This is my first time using this platform, so I wasn't sure if you were going to get to see full screen. Startup fundraising traditionally has been categorized as very risky. Private companies that are illiquid, meaning they're not public, where they have access to a lot of capital, they're untested, they don't have repeatable business models yet and customers. They're heavily regulated by the Securities and Exchange Commission, and that happened all the way back in 1933 after the initial stock market crash in 29. That was the first time the SEC was created, was in 1933, and the idea behind it was to protect investors. A lot of people lost money on speculative investments. There was a lot of fraud that was going on, a lot of kind of snake oil salesmen and hucksters that were selling stuff and selling stock and things that weren't legit. So they created some pretty long-standing securities laws, that most of which still exist in some form today. The Securities and Exchange Commission is kind of the de facto group that oversees everything from stocks sold in the stock market all the way down to private companies that we might invest in, and they do that in different ways. But for startup investing, what they did in that Securities Act is create something, and again, you don't need to know this, called Regulation D, and everything we're going to talk about comes out of Regulation D. And what the Act essentially said is that there is a way for smaller companies to go to the market and sell securities. And when I say sell securities, sell equity in their company, raise money to be able to build their company and give whoever's giving them that money a piece of ownership, to where they didn't have to go register fully with the SEC like a public company. Small companies don't have a lot of money. They don't have the resources to go out and do what a large, well-funded company can do. And so to spur entrepreneurship and to spur innovation, they said, we're going to create guidelines around this so that individuals can invest and these companies can get off the ground. So Reg D was created for that. The other piece that kind of becomes significant that we're going to talk for a second about is this idea of who was allowed to invest in those companies. And it was done for two reasons. It's something called an accredited investor, and you're going to probably hear that talked about a lot, and that's where we've seen some changes even this week. But that's a law that's been around for a long time. And accredited investor meant who could invest in your company, so it limited your investor pool, but it also limited what people were allowed to invest in. And the idea was to protect investors from fraud, basically with the government telling you, if you don't already have a lot of money, you're not sophisticated enough to invest in these risky assets. So we're going to protect you by not allowing you to do that. Some people out there might be saying what I said when I heard that. That seems pretty unfair. And it, to me, kind of reeks of that privilege that's been around this kind of investing for a while, that only the wealthy had these opportunities to invest in these assets that had potentially really large returns. So that's something that people have been fighting to change for a long time. So let's switch to the next slide. Before I get in deeply to what an accredited investor is, I just want to start, excuse me, and lay a foundation of the way startups have traditionally raised money. And here you've kind of got in this very exciting, colorful slide, kind of the four main ways that a startup can go out and raise money. The first is friends and family. And you've heard this friends, family, and fools. It's when you're an early stage startup, your mom believes in you, your aunt and uncle, the dentist down the street, and maybe you cobble together $50,000, $100,000 of their money, and it gives you enough to start building a prototype of something if you're in the tech space, or start exploring an idea. People have different feelings about this. I don't personally like the idea of taking friends and family money because I think it creates inherent conflicts with your family. Nothing is worse than losing Aunt Jenny's money and then having to go to Thanksgiving in a few months and sit down and she wants to know where her $20,000 is and you're out of business. But for some people, this is the one place they can start. Again, I also think this is one of those things that's created a lot of barriers to underrepresented groups being able to get into startups, because they can't, we talk about it here in Birmingham before our fund started, these things called the country club deals, where guys and folks who were members of country clubs had that network could go raise from very wealthy individuals that they already had in their network. So a lot of startups never got started because they didn't even have access to friends and family money, but it is a common way to get started. The other are angel investors. These are typically very high net worth individuals, rich people who've either done a startup, sold their startup, and they want to give back. They want to find startups and founders that they want to mentor. So they kind of invest on their own whenever they feel like it. They write checks of all different sizes. And for some, they kind of take the place of that friends and family. They write really early checks. Usually they don't have to, but that's typically where they come in. I'll give you an example of one. There's a big fund in San Francisco called Kapor Capital. The founder, Mitch Kapor, started Lotus Notes way back in the, I guess, late 80s and made a lot of money on it, has an impact fund now. Anyway, on his personal side, he wrote an angel check for $75,000 into Uber way back when it was still a very, very early company. When Uber went public, I think last year, he took home $375 million from that $75,000 investment. So sometimes these can pay off. Angels are not always looking for returns though. Sometimes it's really about giving back to that next generation and spurring them on. The third is venture capital, which is what I do kind of on the early stage of venture capital. And boy, a lot of noise outside. I hope y'all can't hear that. Venture capital is institutional capital. Very simply, the way a fund is set up like ours, we have limited partners, which are pension funds, large investment vehicles, wealthy individuals, whatever it might be, foundations that want to invest their money in alternative assets that potentially have high returns. They give money to us, and then we get paid to go invest in startups. So basically, we now have control over a set of dollars that they've allocated to us that we put together in a thesis, which means it could be industry specific, it could be size, round, whatever it might be, and we invest in startups at that stage. That can be very specific, and that can be frustrating for people, and that's certainly something we can talk about down the road. And the fourth one, and I don't like to spend a lot of time on this, is debt and bank loans. The truth of the matter is banks do not lend to startups very often. Startups are not asset-based. So very hard, and you don't have cash flow. Banks just don't understand how to lend to startups. So not really a great source, and we get frustrated when banks turn us down. It's not part of their business model. So very few of them do it. So traditionally, we've been very limited in the ways you can raise money, other than if you have money yourself and want to bootstrap it. A lot of this has been, when you hear issues about diversity in startups and other things, you can just see by the funding sources, not everybody has access to this. And so I think as we get into the crowdfunding, you're going to see, I think this is why I talk about it becomes more democratizing. There are going to be a lot more avenues for founders to raise money than there've ever been. So that's the historic way. Let's go ahead one more notch to slide 6. Unless I'm putting Carmen to sleep. I hope not. But I want to take a second and talk about what an accredited investor is. This is a really, really important term that I don't think a lot of people understand. And I mentioned it at the beginning that for a very long time, a Regulation D security, all right, could only be invested in by an individual that was defined as an accredited investor. So what did that mean? Well, there were 3 kind of basic requirements, 2 for individuals and 1 for a business. The first was the income requirement. The individual must have an annual income exceeding $200,000 a year for at least 2 years, or file jointly an income of $300,000 if they were married for 2 years. That had to be substantiated. Or, not and, or you had to have a net worth exceeding $1 million, not including the value of your house. So you had to have liquid assets, stocks, bonds, cash, whatever you could readily get to, of at least $1 million. As you can imagine, that kept a lot of people out of startup fundraising or funding. It also limited the pool of who startups could go to. Third, you had the business requirement, entities, and there's some smaller regulations around this, but the basic idea behind it was an accredited entity had to have assets of at least $5 million. So again, as we talk about some of the things that have been barriers to democratizing startups and getting more people involved, the accredited investor rule, which has stood until, well, it still exists today, but there really weren't opportunities for anyone outside of an accredited investor to invest in anything like a risky startup asset. Let's go to the next slide. So things are starting to break down, and when I get into the history, you'll see kind of where we are today. But there were actually changes to the accredited investor law that were announced earlier this week. I didn't know they were coming, but there are a couple more ways you can become an accredited investor. If you hold a Series 7, Series 65, or Series 82 license, which somebody like me has to have a Series 65 to do what I do, whether my net worth is where it is or my income is, I'm now considered an accredited investor. It means I've passed a test that says I understand risky investments. They trust me to do it. They've also now allowed Native American tribes, and I believe the asset number is 5 million there, to now invest, which is really interesting that they were kept out of that for so many years. But Native American tribes, and there are some very big ones. The Seminole Indian tribe in the state of Florida has 4 casinos. It is an incredibly wealthy tribe. They were cut out of being an accredited investor, but now they can invest as an institution. The third one, which I think is really interesting, is knowledgeable employees of a qualified fund. So if you work for a venture capital fund or a hedge fund and you're a low-level employee and you wanted to write small $5,000 checks maybe, or a $1,000 check along with your investors, you were forbidden from doing that until now. Now they're saying you're sophisticated enough, we consider you an accredited investor. And then the last one was family offices with $5 million or more in assets. So family offices are typically somewhat wealthy families if you're not familiar with them. One of the biggest ones in town is Jemison Financial and that family's office, where they invest in a wide range of assets. Most of them are more than 5 million. So they were, already accredited, but there are some new rules to let them have more flexibility. So just understand that the accredited investor has expanded. We expect it to expand more, but it's still very much a narrow definition of who gets to do that. So let's change to the next slide. And we'll go by this one quickly. And it's just essentially that we now have a game changer. And there's one other game changer I'm going to talk about kind of in the end that I didn't put in this, but it's crowdfunding. And let's, if we go to the next slide, I'll walk you through just a quick history of crowdfunding. And then we're going to talk about all the different types and what equity crowdfunding is, because that's where we really, really want to get to. So crowdfunding is kind of cool. Actually, there are some examples of crowdfunding that go back into the 1700s with an Irish bank that was accumulating money from the community and dishing it out and had good results. But in the modern age, it starts in 1997. There was an English band called Marillion. I've never heard of them. They wanted to do, a US tour. They put up an online payments page in 1997 and raised $60,000. Off the heels of that, another individual decided to found the first website dedicated to crowdfunding and created Artist Share. So Artist Share was one where artists of all kinds could raise money to do digital recording. So if you weren't, you didn't have a label, you could go raise $50,000 maybe, be able to afford studio time and put your music out. Artist Share, I think, still exists today and is still potentially one of the biggest in that space specifically. By 2000, 2004, I was actually working for Senator Tom Daschle. In 1999, we launched the first online payments platform for fundraising for a candidate for Tom's website. I wasn't the mastermind behind it. I just happened to be there when it happened. And the idea behind it was, some of you may know Bernie Sanders. I'm sure we all know Bernie. Bernie used to get up and rave, my average donation is $20 per person. That's a badge of honor that he can keep low dollar contributions. It means you're not bought and sold by the big guys. In political fundraising, especially on the Democratic side, being able to have a low average donor base is really important and it means something. This was a way to do it. We saw it and said, we can aggregate $5, $10, $25 contributions much faster. I fast forward this to 2004 because when my boss, Tom, lost his Senate race, all of our staff went over to work for Obama when he was in the Senate office and then when he ran for president. And as most people remember, Obama kind of revolutionized crowdfunding for political donations. So they raised massive amounts of money through small donations online in both '08 or '04 and '08. And so that really set the tone of where people saw the potential for this, that you could get the power of the masses to be able to raise I mean, he raised hundreds of millions of dollars doing this. And now today it's just something, how many emails do we get from the Biden campaign, Senate campaigns going, can you give $6? That's important to them every time they can do that. In '05, we start to see kind of this peer-to-peer lending. So Grameen Bank in India, which is a micro-lending platform that mostly lends small dollar amounts to women in villages, and they start micro businesses and are able to become self-sustaining. You had Prosper, which was peer-to-peer lending. I could put money out and lend it to somebody on the marketplace and set my interest rate and try to get money back. So a similar version started to kick up. But then it really kicks into gear in '08, '09. And I know you know all these sites. In '08, I believe, was Indiegogo. '09 was Kickstarter. And you had the rewards-based crowdfunding. So somebody would post an item, it would get viral. They're trying to raise $100,000. We've seen everything from products to movies. Veronica Mars, I think, was the first movie that got funded through a Kickstarter campaign. But what we found is people got excited about wanting to attach themselves to something they cared about. What's really neat about these, oftentimes you were just giving money and getting nothing in return, or risking that nobody, the thing didn't get funded. You may not ever get the prize that they told you were going to get, but there was hundreds of millions of dollars invested in these campaigns. All of this leads us to what happened in 2011 and 2012, and it was part of the Jobs Act that came out of the economic recovery from 2008. And it was the Obama administration, along with some really interesting groups out of Silicon Valley and other places, that in the Jobs Act legalized what's called equity crowdfunding, which is what we're going to spend the rest of the time on. But it was a way for startup founders to democratize, and I use that word a lot, their ability to fundraise from multiple sources. And that's what we're going to spend more time on. So let's move forward one slide. And just to summarize, there really are 4 types of crowdfunding that are out there. First is just the donation-based. And if you've ever done a GoFundMe, Indiegogo for the most part is this way. You might do philanthropy. Somebody is raising money because their kid has cancer. You write a check for a cause you believe in. Most of the time, those are pretty legitimate projects, but every now and then you do experience fraud. Steve Bannon, the president's advisor, the Build the Wall campaign, that was a GoFundMe page. They ripped people off, or at least allegedly. But for the most part, they've become very safe, and they take down the projects that are fraudulent. So it's a good way to be able to give directly to people and help them out. We have lending base. I talked about Prosper, Grameen Bank, where the crowd funds a loan, so you can bypass a bank. It's cheaper, it's quicker, and it gives access to people who aren't traditionally bankable. But the 2 most popular, of course, reward-based, which is what Kickstarter is. You give a certain dollar amount, and depending on how much you give, you might, I think for Veronica Mars, if you gave something like $25,000, you get to be in the movie, right? You get to walk on the set and be part of the movie. And then the one we're going to talk about, which is equity-based, you actually, when you give money, you are buying equity and ownership in the company and the rights that come with that. And as a company, you're giving those rights up to get that capital. So let's skip ahead. If I'm going too fast, just get in the chat, say slow down, and ask me a question. I get excited. So within the Jobs Act, this is where they started to break down the rules of what you could do with equity crowdfunding. And crowdfunding is on an online platform. So the first stage was this thing, continuation of what I called earlier, which is Regulation D fundraising. So these were the first platforms that were created. They were only created for accredited investors. So they were still very limited, although you were allowed to market your security or your company or your fundraise to more people than what you traditionally would be able to do. So there were no limits to the amount of money you could raise, no limits to the number of investors. But as we talked about earlier, all investors had to be accredited. They had to have a certain net worth. They had to make a certain amount of money. So it really didn't open the floodgates to what we're starting to see in the last couple of years, which are what are coming out of Regulation A and CF. And I see, Stephanie, I appreciate that. Don't get bogged down in having to memorize Regulation D, Regulation A, and Regulation CF. I put them in because that's what they're called. But within the Jobs Act, under this thing called Title III, they created new regulations that allowed for the democratization of crowdfunding. So you have Regulation A, which was kind of the first one. I've actually not seen anybody do Regulation A, but it's out there. And it's kind of like a mini initial public offering. So a company going public and being able to sell stock to the public, which is highly regulated by the SEC. But this was a way for smaller companies to do it. Under a Regulation A filing, a company could raise between $20 and $50 million. So there were set limits on how much they can raise from both accredited and non-accredited, meaning anybody off the street that had money, almost, and I'll tell you in a minute, could put money into these companies. It was a way for companies to test the waters, to judge if they had interest, because one of the things about crowdfunding that's really interesting is if you start to get traction, whether it's Kickstarter or on Equity, it's a validation that people like what your business is. The hurdle on a Regulation A filing is that you had to go to the Securities and Exchange Commission. You had to get clearance from them to do it, so it was slightly regulated, and you had to have 2 years of CPA audited financial statements. That's really expensive. A financial audit will cost you anywhere from $20,000 to $40,000 a year for a small company. Unless you had the capital to do that, that was kind of restrictive. You're also looking at fees upwards of $10,000 to $20,000 to do one of these. So while that was the first kind of regulation that allowed non-accredited investors, I don't see it used very often. The one that today is gaining the most momentum, and I'm going to show you some examples in a minute, is Regulation CF, and consequently CF stands for crowdfunding. This to me, without question, has become the biggest game changer. Now there's still limitations. Some of these are actually proposed to be changed here maybe in the next year. Right now, companies who file to do a crowd raise for equity can raise up to $1 million. So they're limited by how much they can raise. It's only $1 million over a 12-month period. Here's the good news. It looks like they're going to raise that to $5 million. That may be happening as early as this year, though politics are what they are in an election year, so who knows. But you can raise up to $1 million from non-accredited investors. That means anybody. You can raise more than that from accredited, but you have that $1 million piece that you can go raise from non-accredited. But you can't just go do that on your own. You can't just build a website and say, I'd like to raise $1 million and I'm doing it, I'm soliciting it, and people please give me money. You have to do it through a regulated portal. And I'm going to show you several examples of these portals that exist today, because these portals have to be regulated with the SEC. This is how they reduce the level of fraud, is they use legitimate broker dealers that are people that can buy, sell, and trade stocks to be the issuer along with you. And I'll show you some examples in a minute. So here it's much easier. You have to fill out a form with the SEC, but all you have to do is submit it. They don't review it. They're not accepting it. You just have to let them know you're doing it. They don't have to clear you, but you have to do it on a site that is regulated by the SEC. And again, there's some restrictions on how much an investor can put in over that 12 months. So let's go to the next slide. These are going to be very hard to see, and I'm not entirely sure these are updated because this has changed a lot. And I saw, this is one that's moved around, but even if you are not an accredited investor, and now you have access to these investments, there are still limitations that the government says you can only invest X% of your annual income or X% of your net worth, whichever is higher. So this may be very hard for you guys to see. The first example, it's an investor with an annual income of $30,000 and a net worth of $105,000. And again, that excludes your house. You could only invest the greater of $2,200 or 5% of $30,000. And so you have investment limits on how much you can put in each year. So if you make $30,000 a year, you couldn't write a $30,000 check even if you love the company, but you're getting to invest something. So again, it's the SEC's way of saying you should get access to these, but we're still putting in protections because just in case there's fraud, we don't want somebody losing their entire net worth on very, very risky assets, which we're going to talk about in just a second. So there are still some rules that are in place before you're allowed to do that. Let's go forward and look at what Regulation CF has meant to date. This is what gets me excited. I love when founders have more avenues to raise capital, because raising money from me is actually very difficult. And it's not because I'm mean or a jerk. It's that we might make 5 investments a year based on the size of our fund. And there are probably 25 opportunities I like every year off of 150 that I look at, right? So I have to say no to a lot of people because we just don't have the capital or the bandwidth to make that many investments. So we need to find avenues for companies to be able to raise money in alternative ways. And I think this is awesome. So if you look at the aggregate impact here, since the Jobs Act, since Obama and his administration passed that, 1,500 companies have used this, from accredited and non-accredited. 49 states plus DC and Puerto Rico, companies have been based there, and they've raised over $367 million to start their businesses. That's pretty amazing in the last couple of years, and something that's still very new. What's cool about it is the success rate of actually getting to the raise, and we'll talk about that in a minute, has been approximately 60%. Not everything gets funded fully, right? Some things you're trying to raise $1 million, you have a minimum threshold you have to reach, you don't reach it. That happens on Kickstarter, it happens on all of them. And what it's saying is the market that maybe doesn't like what you're doing, they don't trust what you're doing, they don't like your business model, or you didn't do a good enough job of promoting it. And we'll talk about that in a second too. The investor profile, I think this is cool. 80% of the investors that have invested on these platforms are non-accredited retail investors. So you're getting a lot of people engaging with this that normally wouldn't. What's interesting though is 80% of the capital raised on these have come from the accredited investors. So they're still writing bigger checks, but you've engaged a lot more people to be able to fill in that maybe 20% gap of fundraising. And it's, you know, the average I think is $716 is what I looked up in the research. That's really incredible that people are able to do that. Something, I mean, I've never done this. I know my wife and I have talked about every quarter trying to do some investment in a micro way like this and starting to build a portfolio of startups just for ourselves. So it's a great way to start thinking about building wealth. You're going to miss a lot and you have to diversify. But if you get one big hit, think of the guy who wrote the $75,000 check. Even if you had only written 5,000, you'd have done quite well. So, or 500 even. So as I said, the regulatory impact of this, the SEC is seeing no fraud to date, which is great. Like the big worry is as we open this up, there'd be fraud everywhere. There hasn't been any. And they're thinking of raising that limit up to 5 million. So I think that's awesome. All right, we're getting closer to the slides. Let's go to 14. So I mentioned that there are tons of different ways you can do this now. And this is what's really, really exciting. This is just a handful. There've got to be, I would say, somewhere between 200 to 500 platforms that are starting to pop up. I have friends in Detroit who are building a platform like this specifically to do clean water projects in cities. So for people who want to take a small equity piece of a clean water project in, say, Detroit or in Flint, right? That's their focus. So they're very, very narrow in their focus. Some of these are very, very narrow. Fundana is specifically in the cannabis industry. Some of them are specifically in the real estate space. Some of them, like Seed Invest, which is one that I'm a member of, and I was going to show you, but I can't share my screen, all kinds of different investments in it. And what you're going to do is go on there as an investor, and you can see what the terms are. And that's something that's I don't want to get into in this session, but I'm sure Carmen is happy to share my contact info. If you get into it and want to get some understanding of how to think through what the terms look like on different stuff, I'm happy to sit down and do that. But all kinds of different investments, and you can see, do they have momentum? Do people like them? Are they oversubscribed? And really find what you're interested in. And I think that's just really amazing that we've never been able to do that. Angel List is a really big one. Circle Up is one of the original ones. But this is really just a tiny, tiny sliver of some of the ones that are out there where you can go in and create an account and start investing tomorrow. Or if you're a company trying to find the right platform that fits what it is you are trying to do, which is important. Just like trying to find a venture capitalist, if I'm a biotech firm, I want to find investors who understand biotech. If I'm looking to crowdfund equity, I want to find one that fits with whatever my kind of business is. Is it a local business? Is it a creative business? Is it a scalable technology business? Different ones, you need to do your research, are better platforms for different types of startups. Okay, let's go to the next one. So now I just want to get into kind of in summary, again, another very exciting slide here. Is this right for my company? Is this something you should be doing if you're a founder? First of all, if you love your idea, you're passionate, you have hit a wall, this is an option you need to look at, right? I mean, if all else has failed, you've gone to venture capital, you've tried angels, you're done with bootstrapping, why not? Why not give it a try? That's how I look at things. I mean, I've been there and I've been in that seat before, and it can be very frustrating to have belief in what you're doing and nobody says yes to you. It took me 18 months to raise my first capital. So there are a couple of pros. You don't have to take on debt, so you don't owe anybody. You don't have a personal guarantee, right? Probably less work than trying to get a loan where they ask for years of documents that you may or may not have. You're not personally on the line for anything. You lose all the money, the company lost it, not you. Nobody's coming after you and suing you. You get to broaden your investment pool, right? You get all these people that are now passionate supporters of what you do that are going to go out and be, the impassioned people talking about your product. So that's great validation that they believe in it. And really streamlined paperwork. Most of these sites have it pretty well kind of organized. So when you go on to post a project, it's very, very easy to get set up and get it going. The cons of it, just like Kickstarter, and I talk about this with people all the time, just putting a project on a platform doesn't mean you're going to get funded. You have to go out and do the work. You have to promote it. You have to have quality videos, quality content. You still have to tell story and be able to sell what it is you're trying to do to potential investors, because now you're on a page with 50 other investment opportunities. Why are they going to choose you over somebody else? So there is a lot of work to it. You are selling ownership, so understand that you're giving up some ownership in your company. I don't see that really as a con. I think in my business, we take equity, but we're trying to make the value of the company bigger. And there's the old saying, you can own 100% of nothing or 50% of something worth $1 billion. I'd take the second one every time. Right now, you can only raise $1 million. That's going to change. Check the sites. All of them have different fee structures. Some of them can be kind of high. So make sure you understand that. There is a theory that this could be difficult, and if you raise this money, you see some growth, that it might turn off institutional VC investors like me. I don't know if that's true. I think that's something that's still yet to be determined, but it's something you've got to consider. And then the last con to this is you're still going to be regulated with the Securities and Exchange Commission. There's still things on the regulatory side you have to do. It's not as easy as you get the money and your hands are off of everything regulatory. You got to make sure you're keeping up with it. So there's still some cost to it, but it's the easiest way to do it. All right, slide 16. This is on the individual side. And for those of you who are thinking about becoming investors in crowdfunding, there are risks. And this is why there have been protections through the years. And there are 4 kind of primary ones, and you've got to understand these before you put your money in. There's going to be a high failure rate. You invest in 10 of these, let's say you invest in 10 startups at $500 each. On average, 4 to 5 of those, you're never going to see $1 back. They're going to fail, most likely in the first year. 3 to 4 may return your money back at best, okay? So you may just get your $500 back. What you're hoping is if you build a portfolio and the more companies you layer and stack and diversify, that you have 2 to 3 that actually break big and do really well and have very outsized 10x, 20x returns that then support all the ones that you lost. This is why it's very risky to just invest in one company. That's why funds like mine have 20 to 25 companies in our portfolio. We know immediately 10 of them are going to fail, and we're never going to see that investment again. It's the 4 or 5 that hit, right? That's what we're counting on. So be aware you're going to lose money in some of these companies. Nobody has a 100% hit rate. Fraud is important. Again, we talked about that early. The good news is these sites have gotten really good at regulation and checking the companies and doing their diligence. So fraud really isn't as much of a risk as it used to be. Investment quality. This goes back to the first one on failure rate. These are very early companies with no track record. You're investing in an idea sometimes. You're investing in a founding group. And, they just may not be high quality. The other side of it is, you could argue, why didn't they raise money from an institutional investor? Maybe nobody else liked them, so this is their only option. I don't buy that, but I think some people look at it that way. And then the fourth one is, you have a long horizon that your money's going to be tied up. When you buy a stock, you can sell that stock tomorrow and get your money back if you need that money. If you invest, let's say 10 companies, $500 each, that's $5,000 this month. You probably can't touch that money for 7 to 10 years. You can't call them and go, I'd like to sell my stock. That's not how it works. They're private companies. The only time you can sell is if they have a sale event. So that money is what we call very illiquid. It's locked up. So you can't readily trade it. There's not a market for it. And so for people who aren't used to that, if you need that $5,000 for an emergency, you don't really have any options. It's there. So this is kind of make the bet and let it ride. And I think for some people, you just got to understand that before you go in, that this is money you may or may not see again. Let's go to the next one. This is kind of the last piece I want to hit on. This is the good part. The potential returns. We talked about it. 75,000 gave 375 million. These are high risk companies. If you get rewarded, there's no upside to how much you can get. It's only as big as the company can get. You own 1% of something, if it makes 100 million or a billion, you keep going up as long as the value of the company goes up and they sell. So you have the potential to earn much bigger returns than you would in, say, a bond. For some, this is a reward. You get to play with the big dogs now. And I say that I am not a big dog. The big dogs are in Silicon Valley. You get access to deals that nobody else got to see for years. So you get to play in stuff in a small way, right? And I think for some people that's very rewarding, which kind of leads to the second one. And I love this. It's that degree of satisfaction that now you're invested in things you really genuinely care about. How cool is that? Like, you can find companies you believe in, you love, and now you own a small piece of it. I go back to, and I think about restaurants. People used to invest in restaurants so they could have their name on the bar. Like, that meant something to them. They'd have a little plaque with their name on it, right? Now you can say, oh, I own a little bit of that company, right? I've got these cool companies in my portfolio I'm following. That means something to people. And I think there's something to that kind of investment. And finally, there's the economic impact. You are creating jobs. You are leading the innovation of the next generation, right? Like, being able to fund early stage founders, which is what I get to do, is the most exhilarating thing in the world, because I know if they go on to do great things, yes, I'm going to make money. That's awesome. But we're creating jobs. We're building the economy. We're creating something new that's lastable. If that doesn't get you excited, investing probably isn't for you. I don't get that same level of satisfaction buying Coke stock or IBM. That is what it is. But if I invest in something and see it grow and feel like I had a piece in that, man, that means something. And so I think there's the potential for the financial returns and this idea that you're helping to grow the economy and getting to be a part of that. I think that's kind of neat, even if you're writing a $100 check, right? All right, that was a lot. And I know we're very short on time. I think we've got 7 minutes, and I don't even know if I get that long. I don't know if we have opening for this, and we can certainly do it. I'm happy to come back for another session where we can do it live, but we've got the chat open. Are there things about any kind of investing I can answer questions for the time we have, as long as Carmen allows it?
For it, Kelly Clark wrote a question. If you are a company seeking crowdfunding or investing on one of these platforms, does the company, do you, the entrepreneur, set the equity terms, or do the people who are investing set the equity terms? How does that work?
Yeah, you get to set them. So, and again, I wish I could pull one up. I would encourage you to go to Seed Invest. That's one word, Seed Invest, and you can see, you can pull one up and it'll put on there trying to raise $1 million. It'll have terms like doing a convertible note, the valuation cap of 5 million. Again, that's something I don't want to go into in this presentation, but you basically set the terms of your raise. And, you know, if people like it, they'll invest. If they don't, you might get feedback and you might have to adjust it. But yeah, you set the terms.